bit, but Karthik Kumar is also now joining us. He's fund manager at Axis Mutual Fund. Karthik, good to have you with us here. Thanks for your time. I was just looking at the portfolio that sort of you sent across, and you are, I see that you're underweight IT services, and I think that would be and this is a quant portfolio, right, Karthik?
Yeah. Yes, I do manage the quant fund. Yes.
How would you reconcile with the recent rally, and are you comfortable sitting out if there is how would you deal with it? Because June has been a great month. The IT index, I think, is up about 8.5%, and it continues as we start this July with another 2% today.
So, I mean, absolutely, you're spot on. It's been a bit painful while I've been underweight IT over the last couple of months. But the way I reconcile with my positioning is basically from a data perspective, is that if you look at it, there is a lot of divergence between stock performance and earnings improvement, especially if we look at possible earnings improvements over the next couple of years. And what you're seeing is that the breadth of earnings revision within IT still continues to remain negative. The breadth of recommendations still continue to remain negative. While IT has underperformed the markets over the last couple of years, the valuations per se is not cheap either compared to its own historical premium versus Nifty. So barring the only point, which is IT having underperformed in the recent period, the other points kind of give comfort as to why one would be underweight IT, as in I would be underweight IT as at a sector level. While I do have exposure at a stock level, at a sector level, these are the data points that give me comfort in terms of positioning.
Okay, all right. Hi, Karthik. Good afternoon, Nigel on this side, and good to see you when. If I look at your portfolio, I think private sector banks is something that you've liked, in terms of weightage in comparison to the PSUs. And now suddenly those private sector banks, actually valuation-wise, you're getting the most comfort over there because the stock prices haven't moved up while earnings have been steady. Is that the big theme still? Because even after the recent rally, still valuations are fairly comfortable. Your take?
I completely agree with you there. Valuations are comfortable, and selectively within private banks, you're also seeing growth visibility, growth stickiness, and that gives you a lot of comfort within this market where pockets of growth and reasonable valuation are few, and it's quite difficult to find. So I think in that context, that positioning gives you a fair bit of comfort, not just from a return perspective, but also from a risk perspective.
Karthik, I can see you're overweight on FMCG. Is this a recent shift in your portfolio, or have you always been for the last, say, 6-12 months positive on FMCG? Because increasingly, a lot of investors have tilted towards FMCG post the election mandate and the expectation that we will see welfare spending.
Actually, the overweight in FMCG is quite a recent development over the last 1.5 months. Prior to that, I was underweight consumer staples and FMCGs in general, in particular, and that's kind of changed over the last 1.5 months. And the exposure is more towards names that do have higher rural exposure, and that is coming from the fact that the earnings expectations on those stocks have kind of gone up, and they've gone up impressively in terms of expectations over the next couple of years. Part of that is a function of expected government stimulus on the rural side. That could be one of the reasons. But even other than that, those names seem to have decent earnings visibility and support in the near term.
No, got that. Just a quick word, if you will. I mean, some of the other areas where you're overweight, right? Healthcare, auto ancillaries, engineering and capital goods. So you want to just highlight, especially in something like engineering and capital goods, what are the kind of names which constitute this segment in your portfolio?
Engineering names predominantly, I continue to remain overweight engineering names for some time now. As I said, that's while that space has gotten slightly expensive from a valuation standpoint, from a quality standpoint, or from a growth standpoint, that's where there is comfort. If anything, the visibility continues to improve in that area, which is why I am overweight that space, and I'm overweight that space through some of the MNC names listed in our markets. So that is on the engineering side. Autos, again, is one another area where I have exposure to two-wheeler autos, which do have reasonable rural exposure, along with some ancillaries. That could also be a possible beneficiary of any government stimulus if that comes through. And lastly, pharma is within healthcare. I am overweight pharma, and pharma is a good mix of both robust international markets as well as good domestic markets as well. So all of these three. For different reasons, but in all, I see solid earnings visibility across these three sectors. While barring industrials, the valuation remains on par with markets with the other two sectors.
Karthik, what about Telecom? Everyone's waiting for the election outcome, and part of the street had positioned themselves for these price hikes that we've been hearing about in the last 100 hours or so, with regard to all the three frontline telecom names going ahead and increasing tariffs. Now, in a couple of your portfolios, I think Bharti Airtel is one of the large weights you'll have out there. How much of the good news is in the price, you think? Because the stocks have done very, very well. All three of them. Reliance is a little bit more diversified. Bharti Airtel has been a big outperformer. And Vodafone Idea has given you a quick fire of 50% in the last 2 months. Your view?
As you rightly pointed out, we do have exposure to telecom through the name that you mentioned, and we continue to remain bullish that particular name, and we have reasonable exposure to the sector as well. I think part of the story has played out through the hikes that have come in, but I think the industry dynamics would only continue to get better from here on, which is why we continue to have a positive view on the sector as a whole.
Okay. Karthik, do stay on. Sonia is now waiting.
Something that I thought I'll relate to. But Karthik is still with us. Karthik, you heard what Sonia had to say with regard to the auto sales. Just want to refresh in terms of your positioning. What about the two-wheelers, if you have any comment on that?
I continue to remain overweight autos, and primarily a lot of that is coming through two-wheeler exposure. And some auto ancillary plays, less of four-wheelers, but predominantly two-wheelers. Yes, I do think the companies there, and especially the ones that I have reasonable valuation, coupled with good rural exposure as well. So continue to hold that position.
Any green shoots promise in the specialty chemical space, which has been beaten down?
I still continue to remain underweight specialty chemicals. That's been the case for quite some time. While the valuations are getting cheaper than are getting cheaper, but still there is lack of visibility with regards to earnings in general. So I still continue to remain underweight that space.
Okay, all right, Karthik, we'll leave it there. Thank you very much for your time. Good speaking with you here on CNBC-TV18. As always, it's a pleasure. That's Karthik from Kotak Mutual Fund, manages the Quant Fund at Kotak AMC. Well, 24,150 is where the Nifty is at, which is 136 odd points higher. And there is, of course, a lot of stuff which is going on. I think market breadth has become a little, almost 3